In this video, we'll talk about internal controls over cash, why they're important, and how businesses can use simple procedures to reduce the risk of theft and mistakes. Even in today's digital world, many businesses still accept cash, and cash, unlike other assets, is easy to steal, easy to hide, and difficult to trace without the right controls in place. The fraud triangle explains the three aspects that typically exist when fraud occurs. One aspect is that the employee who commits fraud or theft is experiencing some kind of pressure. Often it's some kind of financial pressure, meaning there are huge personal debts, medical bills, addiction problems like gambling or drugs, or lifestyle spending. The pressure can also be related to performance goals, such as unrealistic sales targets or bonuses tied to meeting difficult financial metrics. Or life events, such as divorce, family issues, or job insecurity, which can create desperate needs. And when pressure becomes overwhelming, individuals seek quick fixes, making them vulnerable to fraud. Opportunity, in my opinion, is the most critical component of the fraud triangle and provides an easy path to commit fraud without getting caught, often due to internal system flaws or poor governance. These include weak controls, such as lack of segregation of duties, like when one person controls the whole process, poor oversight or easily bypassed rules or management overrides, and lack of monitoring, such as inadequate audits, weak risk assessments, and poor monitoring controls. For instance, when the owner or manager is supposed to review invoices and bank statements, but rarely ever does. The employee might also rationalize the fraud, which leads to otherwise honest people to commit fraud by lowering their ethical barriers, making the bad act seem acceptable. Rationalization includes self-deception where the employee rationalizes it by saying, I'm just borrowing it. They owe me. I'll pay it back later, or I'm underpaid. Rationalization also includes ethical decay, meaning convincing oneself the act isn't truly fraud, or that their personal ethics don't apply in this situation. The third factor of rationalization is blame shifting, for instance, blaming the company or circumstances for their actions. Cash is the most liquid and vulnerable asset a business holds. There's no waiting period, no passwords, no tracking, unless we create those systems ourselves. And because of this, businesses must design controls to monitor how cash is received, stored, and recorded so it doesn't go missing, intentionally or accidentally. There's also the hidden cost of accepting cash. Cash handling requires security risk like the late night bank deposits or on-premise robberies. Also, businesses often pay for insurance called fidelity bond to protect against loss or employee theft. Another cost of dealing with physical cash. Digital payments can reduce these risks and costs, but require their own controls. Internal controls also shield honest employees by creating clear procedures and accountability trails. This prevents false accusations and removes suspicion when issues arise. The documentation supports integrity. The most basic and most important control is requiring a receipt for every transaction. This creates a paper trail, so there's a record of every sale and how much cash should be in the register. The business also then reconciles those receipts to the financial statements. All the sales receipts should translate into revenue on the income statement. All cash sales and all credit sales should add up to total sales, and so on. If cash is received but not recorded, there's no way to detect theft unless we compare what's physically there to what's recorded. And that is why the cash reconciliation is so important. Unless receipts are required and those receipts are reconciled, theft may go undetected. Without a receipt system, a cashier could sell an item, not ring it up, and simply pocket the cash. That's why you sometimes see signs at restaurants that say if you don't get a receipt, your meal is free. It's not just good customer service, it's a way to keep employees honest and accountable. Cash should never be sitting out in the open or be easily accessible. The cash drawer should only open when the transaction is entered into the register. This ensures that every time cash is handled, there is a corresponding entry, creating a trail that can be followed. Small changes like this significantly reduce the opportunity for theft. That also applies to the petty cash drawer in the office. It should always be locked, and only one person should be responsible for opening the cash drawer and giving out cash for small expenses. At the end of each business day, the cash in the drawer is counted and compared to what the system says should be there. This daily check helps catch errors and identify suspicious activity early. And if there is a difference, it needs to be investigated immediately before it becomes a pattern or ongoing issue. Companies also track cash variances by store location, time, and employee to understand what issues may exist. That may simply be a training issue or another more serious issue. The key principle of internal control is the separation of duties. The person who takes the deposits to the bank should not be the same person who records the deposit in the accounting system. The person who invoices sales should not be the person accepting or recording cash payments. This reduces the risk of someone misreporting or stealing funds without detection. Even in small businesses, finding ways to divide responsibilities is critical. If separation of duties is not possible, there needs to be additional controls that detect theft. Cameras in locations where cash is accepted, and strict review of all receipts and reconciliations against goods in inventory and sold. Many businesses also receive payments by mail, cash or checks. In these cases, internal controls are even more important. Ideally, the person who opens the mail and handles the deposit should not be the one recording and posting the payments to customer accounts. If at all possible, the remittance advice, which tells us what the payment is for, should go to accounting, while the cash or the check goes to someone else. This helps prevent misappropriation and ensures customer accounts are properly updated. At least once a month, preferably more often, the business should reconcile the cash ledger to the bank statement. This means checking that what the books say matches what actually hit the bank. Any discrepancies should be reviewed and resolved. They might point to errors, delays, or fraud. Regular reconciliations help maintain accurate financial records. Let's summarize what we've learned. Always issue receipts for every cash transaction. Keep cash locked and only open the drawer for legitimate sales. Use separation of duties. No one person should control an entire transaction from start to finish. For payments received by mail, split responsibilities between handling and recording. And perform bank reconciliations regularly to ensure your records are accurate and complete. And remember, good internal controls aren't just about preventing theft. They also build accountability, accuracy, and confidence in your financial systems. I hope you enjoyed this video about internal controls over cash and learned to identify the red flags that are shown in the fraud triangle and what steps to take to protect your business's assets.